Today I'd like to talk to you about rebalancing. If you have $100,000, for example, let's say you start off, I have $100,000, we'll go back to 2007, but I have $100,000, I've got it in a savings account or I've got it in cash because I'm a little uncertain as far as the market, and I may need this money in less than 10 years. So you may decide that, look, I'm not making anything in fixed income, but I need to do something because inflation is going to eat me up. My investment's going to be getting worth less each year, so I need to do something. So I need to put some of this into equities. So we take the $100,000 and we decide based on the level of risk that you're comfortable with, and that's set by the number of years until you need all the money. So say you need to start drawing on this money in 5 to 7 years or so, and we're willing to put 50% in equities and 50% in fixed income because I can handle a drop of maybe 30-40% in my equities until it happens. So we split this. It's the end of 2007, start of 2008, and we have $50,000 here in our fixed income and $50,000 in equities. We're not going to talk about whether this is in international, whether it's in U.S., whether it's in value, whether it's in growth, whether it's in small, whether it's in large. We're just going to keep the example simple. We're going to put 50 in fixed income and 50,000 in equities. End of 2008, we all know pretty much what happened. Our equity side of our portfolio decreased in value. Markets dropped. So let's say in this example, to keep the numbers simple, our equities went from 50,000 down to 30. So we now have 30 in equities, 50,000 in fixed income. We're not going to count the interest here because equities or fixed income didn't really have much of a return anyway, so we'll just ignore that part at this point. So we have 50, we have 30, $80,000, we have a $20,000 loss. We had 100, we're down to 80. A number of years back, there was a fellow that ran, I heard this tale, the fellow ran an article in the Wall Street Journal, send me $5 and I'll tell you the key to successful investing in the market. When you got your envelope, there were 4 words on a piece of paper, and that was buy low and sell high. Buy low, sell high. For a lot of investors, that's an entirely new concept, because a lot of investors, what they would do if they got in this situation, they say, boy, did I make a mistake. I'm down $20,000, sell this and put it back into fixed income because I want to be, quote, safe, and now I'll have $80,000 in fixed income. But the smart investor will buy low and sell high. What does he do? Or she do? Either one. They would take from the fixed income bucket, which still has the $50,000, this is at 30, they would reduce this to 40 and put 10 of that over here into our equity. So we'd buy $10,000 worth of equities that are low. Buy low, right? Sell high, we're selling what's up, we're buying what's low. This is rebalancing the portfolio. We're not stock picking, we're not market timing, we are rebalancing. We are keeping our relationship between fixed income and equities in line so that we control the level of risk in our portfolio. 2008 is done. We've lost money. Rebalance the portfolio. 2009 comes along. Emerging markets up 80%. U.S. market is up for the year. So what happens now on our equity side? Let's say, for example, that our equities, we've got all sorts of colors here, our equities go from 30,000 to 60,000. So we have an increase on the equity side. Now, We have 60 here, we only have 40 here because we rebalanced the prior year. What is our golden rule? Buy low, sell high. So we would sell off part of this and buy part of this. Since we had 60 here and 40 here, we bring this to 50, we bring this to 50, we would be back to our original investment. We would have now 50% here, 50% here. 2010 comes along. Equities increase again. We have 50,000, it went to 60. We have 50,000 over here. It may have earned $5 or $10. Who knows? Fixed income's been down. We all heard that, how bad that is. But we have 50,000 here. We have 60 here. We move 5,000 from here. We put 5,000 in our fixed income. We bring this to 55. 55 is 110,000. We now have $10,000 more because of what's going on in our portfolio. This is called rebalancing. It's different from stock picking. We're not picking stocks. We're not moving money around, market timing, doing any of that. We are rebalancing the portfolio for the purpose of maintaining risk. Fixed income is our anchor, so to speak, because this we know is very stable, especially if it's in U.S. Treasuries and things like that. This is fixed. This is in our portfolio for stability. The equities have higher risk. That is there to outpace inflation, to give us our returns in our portfolio. For that reason, we want to maintain a certain level of equity in our portfolio, and we keep it in balance to maintain our level of risk with which we are comfortable. Any additional information, you can reach us at 561-744-9547 or visit our website, www.smartplaninvesting.com. This is Roy Wiley, your investor coach.